This is Satya Pradyuman of Cirrus Research. The latest issue of the Risk Metrics Report is just out. This is our quarterly looking at cross-market variables such as risk appetites, crowding, credit. A few quick takeaways. One, in a constructive way, what we're observing is that the risk appetites across most key regions are stabilizing compared to just let's say a year, 18 months ago when risk appetites had sprung way too high. In the last 6 months, they had collapsed and now they're beginning to stabilize. In addition to that, crowding used to be a problem. 18, 24 months later, we no longer have that problem. In other words, the amount of investors chasing trending stocks has really reversed course, as we all know from 2022. The good news is that this is now beginning to show up in the indicators, suggesting that some of the sort of outlier risk conditions that existed for most key markets are now potentially behind us. In addition to that, I'll focus in on the credit markets quite a bit here in this report. If you look at the left panel, what you're noticing is that the European credit markets have begun to settle. There's a critical exception, though, which is the UK. What we'll notice is that the credit spreads have not really moved in as much as the rest of Europe. What this is suggesting is that, to some degree, the concerns for growth in the UK is potentially a bigger worry. And as a result, the focus on quality as we've got across key margins, this becomes a bigger role when we're looking at UK stocks. To the right is something that's pretty impressive, really the improvement in credit for high yield markets in Asia. A lot of this ties to the Chinese government and their support for their markets, their real estate markets specifically. It does look as if the bond markets are buying into these supports that have been floated, and this has allowed for a rebound in Chinese stocks. That said, some of the work we've done does show there's a big question as to whether long-term exposure to China should remain as high as it's been. In our report, other key markets seem to potentially benefit from this question. We focused on key areas such as India, Latin America, and other parts of Asia Pacific that are potential beneficiaries of this questioning of whether or not the Chinese exposure in the emerging benchmarks should be as high. In fact, if you look at performance for 2022, what you'll find is that the emerging markets, some of those key markets that on the surface are very risky, sharply outperform most developed markets, notably the U.S. The U.S. is probably one of the weakest markets of the critical markets we track. Notice India. Some of the measures in India were significantly positive. In addition to that, Latin America. So the bottom line here is that as we look for emerging market exposures, we may be witnessing investors begin to look at everything but China as they look for their EM exposure. Take a look at the report, and as always, always happy to take your questions. Thank you.